off with Dr. Laura Raymond, as mentioned before, followed by Henry Gomori. So they'll both speak for about 20 minutes. I'll give you a heads up when when you have around 5 minutes left, and then hopefully we'll have approximately 20 minutes or a bit more even for our questions and answers and discussion at the end. So if I may, Laura, I will hand over to you.
Great, thanks so much. Am I sharing screen?
Yes, perfect.
Excellent. Thank you all. I'm really happy to be here and to hear these talks and engage with this audience around the topic of financialization of rental housing. My name is Laura Raymond. I'm an assistant professor at the School of City and Regional Planning at Georgia Tech. And I'm here today to present a study about what we see as the financialization of multifamily rental housing in our city, leading to gentrification, forced moves, and the displacement of Black residents. The goal of this study is in part to apply econometric methods to understand some of the policy concerns that have been raised using other methodologies. And so we estimate a series of models to see whether investor purchases of multifamily in Atlanta over a 15-year timeframe lead to the types of forced moves and demographic change that we've been concerned about. So this research follows in the footsteps of other work that I've done about the rise of large corporate landlords and single-family rentals after the foreclosure crisis. A quick summary of that work. We found that in comparing the eviction rates of different types of landlords in single-family rentals in Atlanta, that they behave very differently. Overall, Atlanta has a 7% eviction filing rate in 2015. We found that small landlords were very, very close to average, but that large regional landlords were far higher, and that institutional investors in particular had very high eviction rates. This held up in the regression framework where we controlled for tenant characteristics and property characteristics as well as neighborhood. And if you kind of peel back and look underneath the cover there at that large corporate landlord metric, we also found very different property management practices by particular landlord. So this research showed us that landlords actually matter a lot when it comes to understanding housing instability, displacement, maintenance, and that who is the property owner and who's the property manager is a really important consideration for policymakers. There's been other research in the US context. I'm focused here on Atlanta just because all of the studies that I'm presenting are about that city. But one thing that we found since the initial work that we did in 2015 is that there isn't necessarily a cap on the number of properties that these firms wish to acquire. We've just seen a steady increase, consolidation, sure, some firms exiting and entering this sector, but overall the market share has steadily increased over time. So on the left, you can see different firms' footprint within the region of Metro Atlanta, and you can see that there's higher densities in particular areas. On the right, you can see a study out of the Philly Fed, just looking at the change in the percentage of purchases by investor landlords. And I think there's two things that we can note about this literature. One is the percentage of purchases has been increasing over time. And number two is that even though in the US context, in some residential markets, we don't see overall a large market share, within particular submarkets, we see very high market shares. And if you think about that at a neighborhood level, you can see that, but also if you think about, what percentage of the 3-bedroom homes that a particular family might actually be able to rent in this market are controlled by a single landlord or by a single class of landlords. So these are some of the things that I'd highlight. I thought that Martine did a great job of preparing to talk about this study, but one thing that I think is important to establish is some of the rationale for why we think a large corporate investor landlord might operate their properties any differently than a small firm. I think often econometric or economics theory doesn't necessarily highlight why these different types of firms might behave differently. And so I'm just going to refer to the empirics here. What other researchers have seen is that you get very high nominal returns for these properties, and that within a given city, it's the lower price tier zip codes or what is most likely the affordable unsubsidized housing stock that's having the highest increases in rents and also prices, right? So that to me starts to tell a gentrification story or a repositioning story where it's the lower priced properties that are generating most of the yield because there's most of the price increases in that area. And the other thing that researchers have found, in addition to just reading earnings statements, is that fee revenue from late fees, eviction fees, retaining security deposits, deferred maintenance is considerable. And that's part of how these firms achieve their high margin is by ramping up on these tactics. So this leads us to the research question of this study, which in a nutshell is, do large corporate investor purchases of multifamily housing lead to forced moves and displacement of current residents? And we're defining forced moves and displacement in two different ways. One of the ways we look at forced moves is by examining eviction judgments. So we look into the formal court's records and look not just at the beginning of an eviction case, because in the Atlanta and the US context, there's a lot of eviction activity that isn't really related to forced moves. So we don't look at the initial time of landlord files, which might just be part of a rent collection strategy. We actually look at the eviction judgment, which is when the landlord acquires the right to dispossess the tenant of their property. And we just measure whether the eviction judgments are occurring around the same time as investor purchases. And then we also look at racial transition or demographic change within neighborhoods where investors purchase homes. And I'm going to dive a little bit deeper into my design, but not too deep. So a little bit about our data set. We're using deeds data to identify the number of apartment sales in a neighborhood, which we define as a block group. If you're familiar with US Census data, you'll know what that is, but it's a small neighborhood area. And we're looking between 2001 and 2016. So we have 15 years worth of data in our panel. We look at sales to investors. We also look at sales to non-investors. The investor metric is a proprietary measure that's taken from CoreLogic. And when we look at how they're defining this, we're seeing a lot of REITs and a lot of investment vehicles that would be available for investors to purchase. And we also link this real estate data about sales and other, parcel level information about the building quality to neighborhood level measures of eviction filings, which is the beginning of the eviction process, eviction judgments, which is the actual forced move or the closest approximate for it, and also demographic data in order to understand, racial change within these areas. So we estimate two sets of models. The first set of models is a fixed effects panel model where we're trying to see whether when an investor purchases a property in a given neighborhood, do we see a spike in eviction judgments? And we also look, do we see a spike in eviction activity overall, which isn't associated with forced moves? And it's kind of a check to see whether we really think the investor purchase is leading to this repositioning in which all of the tenants are displaced. And then we, again, look, well, if we see this happening with investor landlords, do we also see it with non-investors? So we perform a couple of checks using that set of models. The second set of models, we use a difference in differences design, and we restrict our sample just to census tracts, which are 5 or 6 block groups or 5 or 6 neighborhoods that have had an investor purchase. And we ask whether in a neighborhood that had an investor purchase, is there change in the residential composition relative to the neighboring areas, right? So we'll talk through that a little bit more, and then we estimate a difference in differences. How can we characterize the change in the population where investors purchased a multifamily building relative to the neighborhood next door is the type of coefficient that we're estimating. So there's some formulas here. I'm not going to talk too much about that. I will confirm for those of you who are familiar with difference in difference models that we examine neighborhoods that had an investor purchase in 2010. And if you look at the outcomes for both the treatment and the control, we have parallel trends in the pre-period and then diverging trends afterwards. So it's just an important check for people who use this type of models. And I just want to confirm for people that, that we perform that. So in terms of our results, first, a couple of descriptives. This is Fulton County, and that's the study area where we have our 15-year panel of data. The black outline shows you the jurisdiction or the city of Atlanta. We have a very high eviction rate. In Atlanta, we have very high housing instability and levels of displacement. And it's concentrated in the south of the city and also along the spine of residential rental housing and access to public transit that goes kind of north-south through the corridor. And you can see that the geography of investor apartment sales, doesn't really match up with that, but there's some similarities. Over the time frame that we've been looking at, we had a foreclosure crisis. This is an average repeat sales price index that we calculated using our panel. Essentially, what we're trying to say is how much has the same apartment building price changed over time. So if it sold for X in 2005, how much would that same apartment complex sell for in 2018? We find that overall, the average price for a given apartment increased by $5.5 million. And for a garden style apartment, which tends to be our unsubsidized affordable housing, that parcel price rose by about $3.5 million. So we've seen a lot of price increases for these buildings over time. But here are the results of the first study. And I'm going to show this in two different ways. I'll show you the model with the coefficients, and I'll just also show you a graph. And what we're doing here is we're looking at, in a fixed effects model where we're controlling for the block group, how does the likelihood of an eviction spike change when there's an investor purchase in an area? So when an investor purchases in a neighborhood, do we see a 25% jump in eviction judgments? Do we see a 25% jump in all eviction activity? And then we ask the same question of our non-investor purchases. And what we find here is that there is a 33% rise in the odds of an eviction spike after an investor purchase in a neighborhood in our data set. And that's only related to the forced moves. We don't see any effect of an investor purchase on overall eviction filing activity, which suggests that this is really about displacing people. And then we perform the same model on non-investor purchases of multifamily, and we find that there's no significant change in the level of displacement in a neighborhood in that year if it's a non-investor purchase, and that's true for both the eviction judgments and the eviction filings. So that's our first check. This is, I think, a fairly good model to estimate whether we think that these investors are in a widespread, measurable way repositioning apartments and displacing the current residents when they purchase multifamily apartments in our city. The second set of models looks at whether a neighborhood that has an investor purchase has a markedly higher level of displacement of Black residents relative to the neighborhood next door. And this is the model. These are the important coefficients. And just for those of you who aren't oriented towards model, this is a graphical representation. So you can imagine that this bounded area with the black outline is a census tract, a group of 6 different neighborhoods together. The neighborhood shaded blue is a neighborhood that had an investor purchase of a multifamily apartment. The neighborhoods that are shaded yellow did not. And what our model shows is that in the 6 years following the investor purchase in a given neighborhood, you see 166 fewer Black residents and 109 more white residents. So we're tying this investor activity not only to forced moves in the prior set of models, but also to racialized exclusion and displacement. And we're tying this investment strategy of repositioning to one of acquiring unsubsidized affordable housing and taking advantage of the rent gaps that exist between low-income areas and areas that are predominantly Black in Atlanta, and transitioning them into other market areas. So there's a lot of different results, but the main takeaway that I want to convey with this research is that using quasi-experimental causal models of the city of Atlanta over a 15-year period, we find that investor landlord purchases of multifamily rental housing leads to forced moves and the displacement of existing residents. And that this is an important policy concern that people should be aware of when thinking about whether or not to facilitate the entry of these firms into a city, and also how to handle that situation when it's happening. So some of the recommendations that I hope translate to an Irish perspective are that, number one, government should not subsidize these institutions. In the US context, there was a fair amount of coordination, financial innovation, and subsidy for the creation of the single family rental securitization structure that's allowed these firms to proliferate. It's just not necessary. These firms have access to cheap debt. There are other ways to increase liquidity in rental markets if that's really a goal. And there are other ways to increase the availability of finance for the maintenance and investment into rental housing. In the US context, we sort of emphasized first look, what I call first look programs. So there's different ways that you can provide nonprofits, CDFIs, what we call them in the US, housing authorities, tenants organizations, the opportunity to purchase unsubsidized affordable housing when it becomes available, as we are seeing during the COVID-19 crisis. And so that's important. We've had conversations, around ways to make finance more available to these groups, given that the large corporate landlords have access to very cheap debt. And one of the motivations for having investments in rental real estate is that you can use it as collateral and access even more cheap debt. So it makes it a little bit uncompetitive, I think, particularly as these firms gain steam. And then the other thing that I think, in addition to thinking about financial interventions, where institutional investor is increasing and other types of large corporate landlords, increase anti-displacement policy around, if it's an available policy tool, rent control, tenants' rights, legal aid in evictions courts. Sometimes we've found that evictions arise after disasters, creating evictions moratoria for a certain amount of time if you're having distressed properties because of a natural disaster or something like the pandemic. And also code enforcement becomes increasingly important because maintenance is one of the ways in which these firms seem to save money, making sure that not only are these firms providing stable and affordable housing to tenants, but also that it's high quality and there aren't health issues. So these are some of the papers that we've written around the space. Great appreciation to my co-authors, and thank you so much for listening. I look forward to your questions.
Thank you, Laura. Yes, I'm unmuted. Fascinating presentation. Again, really appreciate it, and lots to think about and talk about there. We'll take all our questions at the end. So if anybody in the audience has any questions, we will take them at the end after Henry's presentation. You can fire them into the Q&A box now if you like, and then I will address them afterwards. So thanks again, Laura. Brilliant presentation, and we will turn now to Henry Gamori from the Department of Sociology in Princeton. Again, we have about 20 minutes for this presentation, and then we'll go on to the Q&A. Thanks, Henry.
Hi, thank you, Mick, and thank you other presenters. That's really interesting, and thanks for inviting me to speak here. I'm slightly under the weather, so I may need to blow my nose at some point. So I'm going to be talking about a similar topic as Professor Raymond. I'll be focusing on small and large scale landlords eviction practices. I'm a little more focused on the sort of day-to-day steady state eviction practices rather than the focus on changing and gentrifying a neighborhood. So just to preface my findings from the beginning, compared to small scale landlords, large scale owners file and evict at higher rates and over less money. File less often as a mean to remove tenants and more often as a rent collection technique, at least in my my site. And these differences appear to be at least partly driven by their corporate organizational forms and arm's length relationships with tenants. So just a little bit of framing and background. I'm going to go through this sort of quickly because I think it's, I'm sure, reviewed everyone here. But landlords are an extremely varied group. And if we think about comparing a resident landlord who owns one property to a corporate landlord with thousands of units in multiple markets, they have very different sets of economic constraints, sort of ways of making organizational decisions, and systems of incentives. And as we've seen, large-scale owners are increasing their market shares due to financialization. So when we think about eviction, why do landlord characteristics matter? For one, their organizational, as any economic transaction, eviction is is affected by the relationships between the two transactors and the way that each makes decisions. So if we think about this resident landlord who's making an eviction decision compared to a large-scale landlord, the large corporate landlords, they usually make this decision in a programmatic way where they're deciding based on a set of existing regulations and decisions that have been made from the top of, say, to file at the 5th of the month whenever a tenant is behind on rent, or perhaps they're using even an electronic system. In contrast, these small scale owners are much more likely to be making these decisions in somewhat idiosyncratic ways and incorporating considerations like the interests of their tenants, maybe the relationship they have with them, in particular when they live with their tenant in the same property. And furthermore, as we've discussed, landlords often file serially without removing tenants, which is something I'll be investigating. So getting right into the data and methods, the site I'm looking at is Boston, Massachusetts between 2003 and 2017. It's a very expensive rental market with many small multi-unit properties, triple deckers, and fairly high filing fees for evictions. And I use data from property tax records and a street address management system to get data on the rental units in the built environment. And then I combine property tax records with business filings to get data on the landlords, and use court-ordered eviction records scraped from the Massachusetts Secretary of Commerce website, the Massachusetts court website to get information on evictions. And I use 911 calls about landlord-tenant conflict to look at instances of conflict during the eviction process. So the main sort of data set that I rely on in this presentation is a data set of landlord characteristics. As I'm sure many people are aware, there's the LLC problem of landlords hiding their identities through shell companies and using kind of complex corporate configurations. And what I do to try to overcome this is use business filings that give information on the owners and basically the members of LLCs, the registered agents, and the principal addresses of these companies, and use that to try to link together multiple companies that are owned by the same landlords. So the first issue in that is matching entities across data sets. So if you see, John Smith in one data set and John Smith in another, is it the same person? And likewise, if you see, 100 Main Street LLC in one area and one is the same company, and then later combining these companies and people into groups. So all the companies that are owned by a single entity, or multiple family members who also own properties together. So when I say landlord, I'm referring to these sort of groups of companies and individuals. And for each one, I create a measure of their scale of operations, the number of rental units they own, their corporate characteristics, whether they're organized as corporations, LLCs, or sole proprietors. I use information on their most common contact address, as well as if they own properties within Boston, whether they have a home owner exemption, to try to get an understanding of their home address in order to understand how close they are to rentals, to distinguish between people who live with their tenants versus live in the same city versus live outside the state. I create a measure of third-party property managers based on the contact address in the property tax records. And then based on their home address, I try to impute household income. And then I also create a flag for whether they have received property from a family member. These last two measures are a little bit shakier, I think, and I'd be happy to talk in the Q&A about sort of data validation checks I used with those, but they're less the sort of focus of the paper. It's more about these sort of measures of their scale of operations, their corporate configurations, and then how proximate they are to their tenants, and whether they use a property manager. So in Boston, Boston is a fairly small scale rental market in terms of the size of its landlords, although the scale of ownership is increasing. As this graph shows, this is for 2 to 3 unit properties, which make up the plurality of rental units in Boston. You can see that the scale by large and medium scale owners is increasing. And I'll just say, so when I talk about small, medium, and large scale owners, small scale owners I define as having only 1 to 3 units. It's a very small scale owner. They're often co-resident, living in the same properties as their landlords, as their tenants, which I think is somewhat unique, but not unique, but is more common in Boston than many markets, since there are so many triple decker properties, which are a useful kind of vehicle to purchase and then have some rental income coming in. The medium scale landlords and these very small scale owners typically own as sole proprietors, and they control about 45% of the market, although there's some ways in which that might be an overestimate. The medium scale owners own about 6 units. It's typically in these like small multifamily properties and control about 20% of the market. And then there's these large scale owners who on average have 55 units, own both really large multifamily properties, but also substantial small scale owners, small scale properties. And often they either specialize in one or the other, and they more often own as corporate entities, and they control about 35% of the market. So I'm going to jump right into my findings. So this is a model predicting both the number of eviction filings at a property, and then a second model predicting the number of eviction executions at the property. This is all rental property years and has controls for property characteristics, tracked fixed effects, year fixed effects, and logged offset for the rental units. It's a negative binomial model. And the main takeaway here is simply that compared to small scale owners, medium and large scale landlords file and evict at much higher rates. So in terms of filings, the number of filings at a property in a year is 55% higher for medium landlords compared to small landlords, and 186% higher for large compared to small landlords. And we see similar proportional increases for eviction execution, though slightly smaller. And what that sort of suggests maybe is that these landlords are also filing serially against the same tenants without evicting them, at least in this context. But one thing you might say is this may simply be a result of the tenants they choose. So it may not be that they actually file more often or more readily, but they just they just cater to a different tenant population. And so it's simply that they're catering to tenants who have a higher chance of being evicted, no matter who the landlord is. To investigate this, I looked at instances of property changes between when basically small owners sell to small, medium, or large scale landlords. And so what this graph shows is the solid line shows property sales from small to large landlords, while the 2 dotted lines show small to medium and small to small landlords. And what the x-axis shows years before or after the property was sold. And what we see is that in this period before the sale, between -4 and basically 0 years, there's some differences, but for the most part, they're not statistically significant, and the eviction rates are fairly similar, but these are the filing rates. And then in the year in which the property transfers from small to large landlords, there's a huge spike in eviction filings, similar to the findings Professor Raymond just showed. And in contrast, when they sell to a small landlord, there's only a very small increase that's only marginally statistically significant or not at all. And it quickly goes back to its pre-sale level of the filings. And when small landlords sell to medium landlords, it kind of is in the middle here. So what this suggests is that it can't be the tenant characteristics that are leading to differences in filing rates, at least in this instance, since in the exact year of property transfer, these large landlords are filing against the tenants. And it looks like this is sort of falling back down to the pre-sale average, but in subsequent years, it goes back up. This is sort of just, as you can see, these error bars are fairly large in the later years. So what we see is a spike followed by a kind of a new equilibrium where these large landlords are continuing to file at higher rates. So next I look at the judgment amounts in these cases as a way of seeing whether these landlords are filing over less owed rent. And this comes from a model that is where each observation is one eviction filing, only for those filings that ended in a judgment, because those are the ones that we have judgment money information about. And we control for the property characteristics and the tracked fixed effects in order to try to control for the imputed rent of the property, to try to make the argument that this is less likely to be about, these are just more or less expensive properties. And what we find, is that the large landlords, when they file evictions, they tend to have judgment amounts that are about $377 on average, lower than the small scale landlords. And the median judgment in these cases is about $2,400. So this is a pretty substantial portion of that, suggesting that these large landlords are filing over less owed money and more quickly when tenants fall behind on rent. So these findings speak to the differences in rates of filing and rates of eviction. And next I'm going to talk about the different reasons and ways in which they evict. So this looks at the probability conditional on filing of executing the eviction or having it be a serial filing. So in these two models, the observations are eviction filings, all eviction filings, and the outcomes are whether the eviction reached an execution, which I operationalize using a writ of execution, meaning the landlord obtained the legal right to remove the tenant from the property, which in Boston is a separate step after receiving an eviction judgment. And then secondly, I look at whether the landlord has filed an eviction against the same defendant in the previous year. And what we find is that compared to small landlords, medium and large landlords execute their evictions less often. There's 68% odds of actually executing the eviction compared to small landlords, and they have much higher chances of having serial evictions. What this sort of suggests is that these large landlords are filing repeatedly against the same tenants for rent collection purposes. And as previous research by Eva Rosen and Phil Garvodin shows, this is a useful tactic that changes the sort of legal relationship between tenant and renter, from landlord and renter to one of debtor and dettee, that then provides the landlord substantial legal rights that they can use to kind of squeeze the tenant. I also look at the chance of landlord-tenant conflict as operationalized by 911 calls that are specifically coded in the calls landlord-tenant problems. I looked at this because I think it's a useful indication of sort of the nature of the landlord-tenant relationship. My hypothesis, in going into this, was that these small-scale landlords, they have these more intensive relationships with their tenants, whereas these, especially if they live in the same property as them, in contrast to these corporate landlords who maybe use a property manager as an intermediary to sort of separate the decision-making entity from the actual tenant who receives the eviction decision, and that these sort of these third-party intermediaries will sort of reduce the degree to which tenants can kind of lodge complaints or have a human face to understand as evicting them, and thereby reducing the interpersonal conflict. So it's less that this conflict is an important outcome in itself, and more that it is an indicator of the nature of the relationship. And what we find is, compared to these small scale owners, medium and large scale landlords have much less conflict as operationalized by these 911 calls. So at this point, what I hope this has showed is these large scale landlords evict at much higher rates more often in order to collect rent rather than remove tenants, and that they have less interpersonal conflict. And so for this final analysis, what I'm looking at is sort of trying to understand why that's happening and which aspects of or which sort of characteristics of these large scale landlords are responsible for their eviction practices. And it was a lot of results to show in one slide, so I kind of consolidate them here. Basically, these are the results from another regression, basically repeating all the analyses I've done before, but bringing in a bunch of landlord characteristics, including whether they live with their tenant, whether they're organized as sole proprietors or corporations, and whether they employ third-party property managers. And I use those as the co-residents as an indicator of these sort of more intensive interpersonal relationships, and the corporate organization and third-party property management as an indicator of sort of more arm's length relationships with tenants and more bureaucratic or pre-programmed decision-making about evictions. And what we find is that the co-residence predicts all of the sort of hallmarks of the small-scale landlords evictions. Co-resident landlords have lower filing and eviction rates. They're less likely to file serially and more likely to execute the eviction contingent on filing, and they have high rates of interpersonal conflict. And the corporate and professional property managers show just the opposite, where they have higher filing rates, higher serial filing, lower execution rates. And I also include these indicators of economic conditions that I mentioned earlier, the imputed household income, and they were sort of inconclusive, but I think given the nature of those indicators, it's not such a clear finding. So this is just summarizing all I said before, but I think the main takeaway for me is that for large-scale landlords, eviction becomes sort of a routine business practice. It's about, we have our way of evicting, we always evict on the 5th of the month or the 10th of the month. We give tenants this amount of time, but it's a sort of programmed decision that is not made on a case-by-case basis and is often even outsourced to another group. Whereas for these small-scale owners, they're drawing on their relationship with their tenant. They're considering to a greater degree their tenant's interest, perhaps. But in any case, they're making these decisions according to a more social logic. This shows a number of robustness checks that are all available on my GitHub. And just moving quickly on to the policy implications, I think what this speaks to is something we've been talking about throughout all these presentations of sort of the profit-oriented logic versus other logics of understanding housing. And I think what this shows is that, increasing the number of institutional landlords, and I'm not even talking about sort of these large scale institutional landlords who are tied to financial sources of capital, but just larger owners with 15 plus units. They're bringing these market logics to bear on their tenants with negative consequences for them. And so I think, though returning to small scale ownership may not be the answer either, I think it's hard to argue that what we need to do is simply, incentivize mom and pop landlords. For several reasons. For one, I think there are these economies of scale that have legitimate benefits. And, one of them being, there was a few years ago, interview by Daniel Aldana Cohen on The Dig, where he was talking about the need to retrofit housing in order to address climate change. And basically arguing there's no way we can do this with such decentralized and fragmented property ownership. And so I think we need to think about how can we take advantage of economies of scale? How can we take advantage of large-scale ownership without basically falling into the market logic? Because I think what really separates these large landlords and small landlords, as we said, is that it's not like they're doing anything illegal or doing anything that is contrary to sort of the logics of a capitalistic housing market. They're really just actually following through these logics to their sort of logical endpoint. And so I think what we need to do is address those logics by removing housing from a purely commodified profit-oriented logic through social housing and basically housing economies that have incentives other than simply profit, since I think these institutional landlords are an example of how obviously that plays out when those logics are brought to their endpoints. And that's it. Thank you.
Thank you, Henry. Brilliant. Another fascinating presentation, and really interesting to see that direct comparison between the small, medium and large scale landlords in the Boston context. So thanks again, and to all our panelists. So we'll move into the Q&A and discussion section now. And so I'll read out a couple of the questions that have come in. The first one from Owen O'Brien, and this is for all panelists, to the extent that it's relevant for your own context or research. It may not be, but a lot of the emphasis in the presentations today has been on what happens when institutional investors acquire existing housing. What about the context where institutional landlords are involved in development, so in the supply of new housing? So it's which has become much more of a feature in the Irish context, although initially there was a lot of focus on acquisition of housing after the financial crisis. In more recent years, institutional landlords are becoming involved in the development process by financing development, essentially. So they're not acquiring existing stock. I'm just wondering if there are any evidence or insights about that side of things from the context you look at.
We've certainly seen build to rent in some of the Florida regions that I've been looking at. I think there's concern about gentrification. If you're building new, that might be less of a concern, but there's also concern about market share and even coordination through property managers around pricing and vacancy. within markets. So these firms don't just have access to capital and access to cash reserves. That makes it very hard to compete in terms of purchasing. But they also leverage digital platforms in ways that are transformative of housing markets. And I think Henry pointed to some of the ways that can happen, but not just around eviction practices, but around setting rents, setting vacancy rates in ways that just extract more rent out of an area. Might be one of the things that I've been thinking about as I look at those numbers rising.
Interesting. Thanks, Laura. Martine, I don't know if that's something you'd like to comment on.
We have in Canada, the big focus for financial firms has been acquisition of existing properties for most of the time that this trend has been underway. But recently there's been a shift in which there's some firms that are now interested in developing newly built properties, which you could call build to rent. We call it purpose-built rental. And I mean, the issue there is that they're only doing it if in certain markets, very like hot markets, there's only some places in Canada where it makes economic sense to build new rental. And it's places where they can rent that for lots of money. And so that it's not really going to contribute to affordable housing. It's going to add rental housing that's on the luxury end. Yeah,
that's interesting. I think that's to some degree that's similar to what we've seen in Ireland. And then finally, Henry, I don't know if you're
nothing to add. That was
perfect. Okay, great. Thanks a million. I have a question here from Maeve McLaughlin, which is actually two questions. So the first is really about and again, I'm not sure you can speak to this, but what about the kind of different contexts and how institutional investors navigate different cities and their different regulatory structures. So Maeve is interested in how institutional investors target or bed down in specific urban context, and what, if any, types of relationships do these sometimes global actors build to help them set up and navigate the varying regulatory contexts in different cities. So Maeve is a geographer. You won't be surprised to hear from the nature of that question. So I'll open that up to the panel to see if anybody would like to come back on that one.
I'll speak just briefly about the Boston context. I'm beginning some comparative work to look at different contexts, but in Boston, I've been somewhat surprised by the lack of large-scale institutional investment. And research has shown in the U.S. that most of these like really large-scale investors have been in sort of Sunbelt areas and often less expensive markets. And it's an interesting question of why. I mean, a huge factor in Boston has just been the housing stock that exists. Most of the housing in Boston was built 70 to 100 years ago. And there's a huge amount of these triple-decker small multifamily properties that really incentivize this small-scale resident landlording. And I think it's an interesting situation where it's such an expensive market. In some ways, I would have expected it to be these really large-scale owners who actually have the capital to invest, but it's quite the opposite. And gentrification in Boston, at least, has often taken the form of, as it often does, of increasing home ownership. So there's a lot of instances of these triple deckers being owned by small scale landlords, being purchased by large scale corporate entities, converted into condominiums, renovated, and then resold to 3 new homeowners who tend to be richer and whiter than the previous residents. So I can just say that seems to be what's going on in Boston.
Thanks, Henry. Laura and Martine, I don't know if you'd like to come in on that question as well, or I can move on to the next question if you like.
Just echo what Henry said, that when you look particularly at single family rental investment, that has been the Sunbelt cities in part. This business has emerged in the footprint of subprime, the subprime mortgage and subprime and foreclosure crisis in the United States. Doing an analysis right now, looking at cities in Georgia, Florida, we are seeing that there's different regions that are the focus of, platform buyers and sellers who are disrupting kind of realtor markets, as opposed to single family rental investment, as opposed to multifamily. So within a city, yes, there are differences, between different regions. It appears that Tampa has a different value proposition than Atlanta. But I definitely echo that we see more of this in the Sunbelt area. The Rust Belt, the center of the country, had a lot of distressed housing selling for very low prices, but because the long-term forecast wasn't the same, what I was seeing, at least in the past 5-10 years, was that there was less interest in investing there. So it was distressed property in areas that were overall perceived to be growing, is what I see.
Mm-hmm. Thanks, Laura. Martine, I don't know if that's something you want to speak to, or I can move on to the next question.
Maybe just really briefly, I think one of the things that when global actors come to Canada in order to get into multifamily, what they often do is enter into joint ventures with existing institutional firms to get a sense of the lay of the land and to understand how to operate in this context. I mean, we have an issue too where the Canadian market is relatively small, and so not necessarily big enough to attract some of the big money. And in fact, not necessarily even big enough for all the domestic investors. And so they are going to the US and other places. And so kind of to maybe second point here about the appetite for international collaboration, I think that's a great idea, because it's certainly the case. I mean, in Canada, I study what these firms are doing here, but so many of them have different arms for their international investments. And so I think it would be super interesting to explore a firm's reach around the world. And people have done this kind of thing for like Blackstone, which is operating everywhere, right?
Yeah, absolutely. Very, it's a really interesting point. And in the Irish context, of course, most or many institutional landlords, especially in the first part of this process, or the first phase of this process, where our North American countries, you mentioned, Martine, CapREIT, which established what is now the largest landlord in Ireland, IRES, and we have the companies, I think Maeve mentions there, Kennedy Wilson, which I think is Los Angeles based, and one of the biggest players in Ireland, Hines, is I think a Texas based company. So it's maybe something particular to the Irish context is that it's a virtually 100% international funds and institutions entering into the Irish market, a market that was previously completely dominated by Irish actors. We have a couple of other questions now, which are more so based on the one on the security of tenure and tenant protection types of end of things. Katrina Lawler asks about when properties are sold with vacant possession, which is the norm in Ireland. In other words, to terminate a tenancy and evict a tenant before bringing a property to market, which is in Ireland permitted under rental legislation. Katrina says, the assumption by many is that our new institutional landlords are more likely to sell property portfolios with tenants in situ, therefore increasing security of tenure for tenants. Based on the US/Canada situation, does the panel think this belief is misplaced? So, I mean, we do see in commercial real estate, it's very normal for commercial rented buildings like office blocks to be sold with the tenants in place, but usually in Ireland that has not been the case for rental properties. I don't know if anybody would like to speak to that.
Well, I was going to give Martine a chance to jump in, but I guess I'll jump in. What my research has shown, I think the latest paper has shown, is that when an institutional investor purchases a building, it is with the goal of renting to a higher income of tenant and possibly a different community altogether than the tenants that are currently there, regardless of whether or not they purchase the property with the tenants in place. And so if that behavior is replicated across the pond, then you wouldn't expect to see the same income people in that building years afterwards, because the purchase price, the leverage, the goals of the firm managing it are to increase revenue through rents or through resale, one way or another. And that's predicated on replacing not just the individual, but the income level, the rent level of the people in that building.
Yeah, sorry, I have a follow-up question if I may, but I'll just see Henry or Martine, you might like to jump in.
Yeah, just really briefly, I mean, you're not allowed to evict tenants for a sale in properties that have, I think, more than 3 or 5 units. So they're always sold fully tenanted or whatever, with a certain amount of tenants. But I agree, if the goal is to provide security of tenure, policy can do that. But trying to promote institutional ownership as a workaround to try to build security of tenure is just misplaced.
That's interesting. That's really interesting. But it does suggest that if you prohibit landlords from institutional landlords from existing to sell, it's viable. It continues to be viable. I mean, it is in the Canadian case anyway, which is interesting. Henry, I don't know if you wanted to.
No, much, just sort of echoing what Laura Raymond just said. Yeah, I think if you are a tenant who is providing the highest possible rent, your tenure is probably much more secure. But if not, you're in trouble. Just from even in Boston, a very different context. We saw when these large scale owners purchased, they tended to evict at really high rates in that first year.
It's really interesting. I mean, it does, I think, echoing Katrina's point, it really, a lot of what you're saying does contrast with a lot of the discourse in Ireland, which has argued that institutional landlords are very focused on long-term returns and have a much more long-term. And it's even argued that they have a low yield strategy, which is sometimes connected to the fact that in many cases they're linked to pension funds. Not a low yield strategy is not the correct way to put it, but rather to say that they're more interested in long-term stable yields rather than in, flipping and, rent evictions or those types of practices. But that it very much contrasts with what you're saying, which at the very least suggests that we should be open to the idea that institutional landlords can take different forms, and one of those forms can be a much more kind of short-term, aggressive, as has been put here today, type of property management and tenancy management strategy.
I would just say, sorry, do you want to go?
I just wanted to say 7-8 years ago, it was sort of an open question of what sort of landlords would these folks be. And many of us were sort of agnostic and thought, hey, maybe there's a good thing about turning, single family homes into rentals. There's a lot of potential upsides. Those upsides were not realized in the US context, as far as I can tell.
And I was just going to add, I think that strategy we're talking about of removing tenants and replacing them with, higher paying ones, that really can be a long-term strategy, right? Because I mean, in that first year, you're losing a lot of income from having evictions that can be drawn out, but you're maximizing the long-term income.
Yeah, interesting. Martine.
You also get different strategies from different types of firms. So there's some firms that are focusing on what they call like the value add buildings, which are these ones that we've all talked about, where there's this big opportunity to raise rents. And some firms will do they'll call it like the heavy lifting of taking those buildings, cleaning them up. Like that one firm, Timber Creek, I talked about, they talk about putting a building through a car wash, where they'll do the effort of getting rid of the tenants that are in there, renovating the suites, raising the rents up, and then they sell that, what they'll call like a stabilized asset, a core asset, to a pension fund that might be more risk averse and be willing to accept a lower return for a lower risk property. So there's different ways about it, but I think that the point still stands that institutional ownership isn't a backdoor to getting security of tenure. If you want security of tenure, like work on policies that will actually provide that. I think that's a more straightforward way to go about it.
Yeah, well, very well put. We've another question here from Emma Byrne. this time, well, Emma asks about the development of institutional investment over time. So she makes the point that institutional investment in Ireland is currently focused on the build to rent luxury or higher end segment and the high end student accommodation segment, rather than on providing housing across the market. Have the panelists found this is where institutional investment began in their jurisdictions before expanding into different parts of the market? So I suppose about the kind of trajectory of the segments that are invested in over time.
I mean, we do have that here in Canada. There's a nascent, or I guess a growing focus on building luxury student housing by financial firms. Also, the new build financial market in Canada that's quite strong is retirement living. So you have lots and lots of investment in that, and the financialization of seniors housing here is huge. 42% of retirement living is owned by these financial firms. And that's where they're doing a lot of building, and it is a luxury, like $6,000, $7,000, $8,000 a month to rent in some of these places, really, really expensive. But in terms of the multifamily, like I said before, in Canada, the play has been to consolidate existing, and then there's this new sort of early interest in building new. And often that's because these firms are looking to intensify existing properties. So they're buying stuff built in the 50s, 60s, and 70s, apartments that have a lot of space around them, or maybe a parking lot, and they're going to use that land, which to them is basically free, they already own it, to build new, because otherwise it's not like the prospect of buying land and developing a new property here is just not that appealing to developers. But for a lot of the existing financial landlords that own old properties, they can build new on particular downtown sites in some places where that'll be profitable for them.
Thanks, Martine. Would anyone else like to come in on that, or on that issue? Sorry, or will I take another question? Okay, I have a question here. I can't see clearly who it's from, but Muireann, I think, who asks, it seems to me that our biggest issue in Ireland is policy and tenant protection and lower space standards. Do you think that better policy could create an environment suitable for both tenants and institutional landlords, or will they leave a tightly regulated market? Which is an interesting question, and it kind of reminds us of, in Ireland anyway, a kind of a reference in this debate is markets like Germany and Denmark, which traditionally had large landlords, professional landlords, and sometimes were kind of the financial institution linked landlords as well, but have operated over a long period in the post-war era in very tightly regulated rental markets, which have very strong security of tenure and rent controls in many instances as well. That's often referred to in the Irish debate as, if you like, something to aspire to. Because our sector is traditionally quite a chaotic mom and pop landlord sector with a lot of very, very poor outcomes for tenants, along the lines that Henry talked about at the end of his presentation. So I wonder, would any of you like to come in on that one? What is the potential here for much stronger protections for tenants, and can that kind of square the circle?
I'll just say, I think it really depends on what those regulations look like. And so I think if it is regulations that are, it really reminds me of the debate in the US about right to counsel in eviction cases, which I think is a really important thing for tenants to have, but I don't think would do a ton to actually change the residential insecurity that tenants face, since, the vast majority of evictions are for non-payment of rent. And they, even with, there are these abuses on top of the legal actions the landlords are doing. But even if we get rid of those sort of illegal abuses that are going on through more renter protections, the heart of the issue is that there are a huge number of people who can't afford rent. And according to the logic of our system, they can't have housing. And so I think it has to be regulations that kind of get at that logic. And so get move more toward decommodifying housing. And so I think, things like right to tenure or, any type of regulation that recognizes a right of control or, pseudo ownership for renters is getting more at a system where it is counterbalancing the property rights of the owner with the sort of rights of the tenant from having lived there. But I think it needs to be regulations like that sort of strike at the heart of the sort of capitalist logic of the system, rather than ones that just make that system run a little more smoothly. Because I think without really addressing the main issue, which is that I think all the things we're talking about as negative aspects of institutional ownership are totally legal, totally, part of the market system of, changing a housing, like upgrading housing and kicking out all the tenants and bringing in more higher paying tenants is like the system working as it is designed to do. So I think unless we sort of strike at that logic, those protections won't do a ton.
Thanks, Henry. Laura or Martine, if you'd like to come in on that, you may, or I can move on.
I could certainly entertain the notion and be optimistic. All my research is focused in very unregulated housing markets with high poverty rates. So it's really hard for me to translate to a Berlin or a Denmark.
I think more regulation is great. I mean, I'm noticing in the chat, Manuel Albers has noted that German rental markets are more regulated than most and have the biggest market for residential REITs. So it's not necessarily the case, I guess, that regulation will keep institutional players out. But I mean, we saw them flock in to places that became deregulated, right? It is certainly the case in Canada, where these firms talked and they're, offering documents about, hey, check it out. This is about to become deregulated. We have this opportunity to make a killing here by raising these rents. So preventing that would definitely keep housing prices lower and prevent tenants from being gouged as much, and would cut into the profits of these firms. Maybe they would stick around, as they clearly have in Germany, or but they might be forced to accept lower yields, right? And if regulation does push institutional firms out, I think that's a great thing. To me, that would be one of the goals of regulation.
Thanks, Martine. A really interesting question. And indeed, in Ireland, I mean, we have seen significantly stronger regulation in terms of rent regulation, of rent increases, and in terms of tenant protections to some degree, or at least some steps forward there. And that period of greater rent or greater tenancy protections has coincided with a boom in institutional investment, which would suggest, I think, that institutional investment would be or could be compatible with a more strongly regulated market. Although the caveat there, I think, would be, returning to a point that's come across really strongly across today's session, landlords differ and have different strategies, and the characteristics of landlords matter for outcomes. So it's probably not a good idea to make blanket statements. Sorry, Martine.
Sorry, I just wanted to also add that in the research that I've done, I looked at the different levels of real estate trust penetration into Canadian provinces, comparing ones with stronger versus weaker rent controls. And there's a very strong pattern that emerges, is that the provinces that have strong rent controls have much lower proportion of REIT presence than you would expect, given their overall proportion of Canadian rental housing units. And so there is a certain cooling effect that the regulation does have, but then you still see those firms coming in, because it's often possible there's workarounds, and they'll still enter the markets, as we can see by Manuel Alber's comment. But it does have an effect, and the firms certainly talk about it. I mean, in their own way of seeing it, they talk about how regulation is the worst thing ever. They really want to prevent it from coming in. So, yeah.
Thanks. I've one more question here, which there's a good few more questions coming in. I'm not sure how many more we'll get to, but I'll certainly take this next one from B. Desmond. Is there any research comparing rental price growth in cities with a higher percentage of institutional ownership versus cities with similar demographics and lower institutional ownership rates? So some kind of direct comparative analysis between different cities with different levels of institutional investment. I don't know if anybody's aware if such research has been done. No.
That work on rents and rental data is a little bit messier and harder to get at in a US context. So I'd almost prefer to see a within city analysis, just comparing similar properties with different owners. I have seen work done on home prices and crowding out of home ownership. And that work suggested that single family rentals owned by institutional investors did crowd out home ownership and did raise prices in kind of local submarkets, the rental space, but in terms of the impact of increasing single family rentals on owner occupied housing stock.
Thanks. Yeah, thanks, Laura. It's interesting again, that submarket theme. One question, which will be our last question from Elaine. Short-term letting platforms like Airbnb, have they played a role in the financialization of housing, specifically with regard to institutional landlords in the context you're working on?
That's an emerging topic. I just went through an analysis of sales over the past 2 years in 4 southern cities and found that these trading platforms like Zillow and Opendoor are accounting for a high percentage of sales during the pandemic. And I don't have a great answer for what effect that's happening, things that urban planners care about. But it's not going to, we saw that Zillow is claiming to have exited the market. So, but there are other large players who are still buying and selling homes. And I think that's an open question and one that's really interesting.
Thanks, Laura. Okay, I think we're just coming up to 4 o'clock now. There was so much to take out of that. To be honest with you, it would be great to keep this discussion going on forever. I mean, what emerges so strongly for me is that landlord characteristics matter. The nature of landlord characteristics are really important, and institutional landlords obviously specifically, and they have impacts at the level of tenants and tenancies in terms of eviction, in terms of rent increases. They have impacts potentially at the levels of neighborhood, geographical change, segregation, or demographic change, and they have implications at the level of markets through dominance of potential dominance of submarkets or particular localities or regions as well. So, the assumption that institutional landlords will de facto bring about positive outcomes for tenants and for markets would seem to be erroneous on the basis of what we heard today. And I think it really underlines how important it is that we, continue to discuss this issue here in Ireland, but also to generate research on the Irish context that can help to inform debate and policy. Thanks so much to all our attendees and for the brilliant questions. I think there was a lot of questions and discussion in the chat, which I wasn't able to keep an eye on. I was just looking at the Q&A box, which is separate. So I'm sorry if I missed any questions that were coming in through the chat function. But thanks to everyone for attending, and in particular, a huge thank you to our 3 brilliant presenters who've gotten up very early in the morning in North America and given over a lot of time specifically to come and take part in this discussion here in Ireland, which has been hugely fruitful. So I'm really, really grateful. And I will follow up with an email with the recording of the session to all attendees ASAP. So I'll close the webinar there and just say thank you very much once again, and see you all soon.
Thank you.